Hello, everyone. Welcome to today's webcast regarding lease accounting. My name is Adele Erdman, and I'm delighted to welcome you to today's event. I wanted to start by taking care of some housekeeping details. During the presentation, the phone lines are all muted due to the size of the group that we have together today. If you have any questions, please, during the presentation, go ahead and type them into the question and answer tool that is located in the right-hand side of your screen. We will attempt to answer as many questions as possible during the time that we have allotted today, but if there are unanswered questions at the end of the event, we will respond to those via email. If you are seeking CPE credit for today's webcast, you must respond to each of the polling questions during the webcast. Today's webcast is worth 2 credit hours, and again, if you're seeking credit, you must respond to all of the polling questions. Today's speakers are Sean Lager, audit partner with Frazier and Deeter, and a member of the AICPA's Technical Issues Committee. Sean is joined today by James Holmes, Senior Vice President with BB&T. So those were our housekeeping items for today. Let's get started.
Great, thanks, Adele. Hello, everyone, and welcome to our webcast. We've got a large group, looks like online. So one thing I'll mention, just piggybacking off what Adele said, if you have questions, please type them in, and we'll try to save some time at the end of the webcast to answer those questions. We may not be able to get to all of them, but we'll certainly do our best. So we're really excited to present today's topic, lease accounting, given by the size of the group. This is certainly a popular topic and has been for the past decade. We've got an interesting format today. James and I, who go back a long way, have been talking for the past several years the potential impact, and I, for my firm and the network, have been following this project since day one for many reasons. But as I was telling James, I've done a lot of presentations on this locally and globally related to IFRS and US GAAP. But I get a lot of questions related to how will this impact my banking relationship, covenants, and other areas. And of course, a lot of those, especially on the non-public and public side, center around the bank covenants associated with bringing these liabilities onto the balance sheet. So I told James I'm not an accountant. I'm an accountant but not a banker, so I figured he could answer those questions better. And as we continue to discuss the impact, he certainly continues to raise good points related to the adoption of this standard going forward. So I would think you're getting a lot of questions on this, James.
We are. We're being very proactive with our clients. This is something that we're also bringing to their attention, that they need to have discussions with their CPA and also consider when they're engaging in any type of financial contracts so they understand the impact.
Right, right. As I tell some of our non-public clients, your bank's your biggest investor generally, so you certainly want to be proactive and communicate related to the potential impacts of adopting the standard. And as you'll see, there's certainly still plenty of time to do so, but it's not something you want to wait till the last minute to understand what this will look like. And we'll give some tips on that as we go through today's presentation. Let me go over a quick agenda so you know what we're going to talk about. The first thing is we'll discuss a timeline, take you down walk of history lane on where the boards have been on this. When I say boards, I mean the Financial Accounting Standards Board, or the FASB and the International Accounting Standards Board, the ISB, who issues IFRS. And so we'll discuss that briefly, and then get into the definition and the scope of the standard. We'll talk about lease payments and lease terms, lease classification, what I call the day one and the day two accounting related to this standard. And then we'll briefly discuss the lessor model, but given time and there wasn't a major impact related to the lessor side, although there are some differences especially related to the classification of sales type and direct finance leases. So we'll touch on that briefly, and then we'll give you some going forward thoughts on, I guess, some opinions James and I have on adopting the standard. Okay? As I said, this has been out there probably since Moby Dick was a minnow 10 years ago, and discussed even before that between the boards. This was the result of a couple of things. One, an SEC letter that was issued that, amongst other things, asked the FASB to address off-balance sheet arrangements. Of course, leases was one of the major topics included in that letter. But also, and as important, was the convergence project between the IASB and the FASB. And this was, they had several different types of projects, where one was a joint project, which this was. There's also modified joint projects. And the joint projects were the two boards worked together to come up with a completely converged standard, or a substantially converged standard. The modified joint projects were the such as like fair value, where one board took the lead, deliberated the standard, and the other board, after that standard was issued, would fall behind and do the same. So the board started talking about this, or deliberating it, at least more than 10 years ago, and then there was the first ED was issued in August of 2010. And what's somewhat strange, if you don't follow standard setting, there were two exposure graphs issued. This and of course revenue recognition had two EDs issued as well, which you normally don't see. And quite simply, I think, and I think a lot of folks would agree with me when I say that the FASB and ISB both really missed the mark on building the model. What I will say is, over time, that there's one thing that's been pretty consistent, and that most folks thought that these types of arrangements belonged on the balance sheet. So most of the tension around the standard, as the boards continued to deliberate, were the model itself, and how you determine what the lease liability is, or the right of use asset is. So, and for those of you that have been following the project since the beginning, as you know, there were major changes all along the way, really to come back to a final standard that was issued in Q1 this year, that got us to something that's fairly close to what we see today with old FAS 13, and the difference being operating leases still finding their way to the balance sheet. And we'll certainly go over that. One of the things that I found odd is, you know, the accounts, we look to the correlation between the balance sheet and the income statement as you unwind assets and liabilities into the P&L. There isn't that correlation between the two, because one of the things I think folks were up in arms about was the front loading of expense related to operating leases. As exposure draft number 2 had both an operating and a finance lease option that started to address that fact, and then came up with a new model in the somewhat new model in the final standard. One disappointing thing was that the ISB and the FASB ultimately went different directions at the end. The ISB elected one model, and that's the what we call the capital lease model today for most all their lease arrangements, where we have two models, and we'll get into that. But some of the major changes were obviously parking the operating leases on the balance sheet, eliminates the specific real estate provisions associated with real estate leases and determining classifications. The new presentation disclosure requirements, changes in sale and leaseback criteria and how they apply to lessees and lessors. We won't get into that today due to time. Also modifies the criteria and accounting for sales tied direct type financing leases, as I briefly mentioned earlier, and then completely eliminates levered leases prospectively. Exactly. So those are some of the major changes. All right. Okay. Let's talk about the definition of a lease, and one thing I want to focus on and get your thoughts on, James, is, you know, for the most part, this didn't really change a lot. It did introduce where the lessee has control over the asset, and it adds some more guidance in how you make the determination that your arrangement contains a lease. And a couple of thoughts on this. One is especially when you've got a service arrangements, when you have an embedded lease arrangement that typically would be an operating lease for that asset embedded within that contract. I would say a lot of times in current practice that gets ignored just because the ultimate accounting really is the same, because you're recognizing the expense over time as it's incurred related to that lease arrangement. What I think you're going to see is that because of the accounting implications now of these lease arrangements finding their way to the balance sheet, that there's going to be more attention paid to those embedded lease arrangements. Okay, and so meaning that where something may have been classified as a G&A expense now could be classified as a lease expense. So, and I know you guys tend to look at the lease expense and for the operating leases and disclosure of the financial statements, and a lot of times perform your own calculations, right, of those liabilities. So you see that being a problem where now, I mean, the number could go up if in related.
Well, if it's going to impact, it's going to be classified as debt and increase the leverage, then yes, there's a need that we will probably need to revise covenants in some way. Now, the trick of this is the chicken and the egg. We won't know exactly what kind of adjustments we can make on the covenant and set that new target until we kind of know the adjustments that the CPAs are going to make to the balance sheet. And so those play both in hand. In most instances, key bankers have historically looked at, when we look at the operating lease, we have capitalized those on our own when we are calculating during our underwriting process. And so we have an idea already. Banks have been doing it on their own kind of during their underwriting process, but maybe it didn't make it to the loan agreement or the actual calculation of the covenant. And so now that's going to be just basically implemented now, that you're going to look at that from a different perspective. You guys are going to give us what that liability number truly is and how we should look at it.
Okay, I may be getting ahead of ourselves when I say, how do you guys determine what that liability is? I've heard you may take a rent expense in the disclosures, so apply a factor to that, or
so you may take a rent expense, an annual rent expense, and take it times 5. Look at that, throw that as a liability, and when you're doing your calculations, you'll see what your leverage is. So if you're using a funded debt to EBITDA, you may add that number into that funded debt figure. But again, depends on the life of the asset that's being leased, how long those contracts are. All that'll play in. You guys are now making it official for us, so it'll make it a lot easier.
Okay, so I got to ask you this: where does the 5 come from? I've heard 5 sometimes. I've heard 6, and I've got a question, and I said I have no idea. Is that like an industry?
That's just the industry figure people have used over the years, and we kind of take an estimate that 5 or 7 is the typical transaction period.
5 to 7. Okay. So the problem in lies that now you take that disclosure, right? Notwithstanding it'll fall on the balance sheet when you adopt the standard. But that rent expense number could look different just because arrangements falling into a lease, and we'll talk about separating non-lease components, the impact going the other way. So one is you got rent expense that could be different, okay? And 2, when you're using a 5 or 6, obviously that's not the model here. We'll go over that. So we'll come up with a different number. Is that a problem, or is that we're not sure yet?
We're not sure yet. So I think what you need to do is, this is why it's important we're having this conversation today.
Okay.
We need to have early conversations with our clients and their CPAs to see what this will look like. Once you have that idea, you can make the proper adjustment.
Okay, got you. Thanks for that. Anyway, so the definition, the principle's basically the same. I think the issue that potentially could arise is there's more guidance within the new standard on how to determine when you've got a lease and you've met the two criteria related to control and the identified asset test. Okay, and then even with this introduction of control, you know, because if you consume majority of the benefits of the asset, that's you have a lease currently, but now you have to meet the control criterion, and that you can direct the use of the asset and have control over the term of the contractual term of the lease arrangement. Another change that related to the lease is when you start the accounting for the lease, the commencement date versus the inception date. So now you're looking at and making these calculations, which will be at a different date, which I'll mention when we start talking about the lease payments. Okay, lease payments. Now, for the most part, which you'll see is generally the definition's the same. Okay, when you talk about the fixed payments associated with the lease arrangements, variable lease payments, which were included in ED1, and that created a real issue, especially when you were looking at a variable lease payment, say as a percentage of sales, which was in ED1, that would be considered a lease payment. A lot of folks, including myself, disagreed with that concept. One point I will make that's not included in the lease payments today in determining the estimate or determining if you have payments based on an index or a rate. Okay, so that obviously impacts the lease payment. That would not be impacted now when you're calculating, say, your capital lease liability, which we refer to in the new standard as a finance lease liability. So that will certainly have an impact. And making that you determine the payment at the date of the lease, and then you run that in your lease payment calculation when you're determining the present value of the lease payments. One major difference in the standard is this introduction of the non-lease components. Now this James could certainly have an impact, and now I will say this before I go through this. This can get complicated, and the boards acknowledge that, and so what they did provide for is a practical expedient. When you cannot determine or you find it complicated to determine, there are criteria to adopt this practical expedient. You just adopt it by asset class. But if you find it complicated to do so, or just don't want to determine what the non-lease components are, you can combine those lease and non-lease components and call that your lease payment in determining the value of the liability. Okay, so again, that can get complicated, but buyer beware on that. And what I mean by that is that's going to create a higher liability if you do, could impact your classification test. So I would caution those that do exercise that practical expedient that beware of the implications associated with those payments. One thing I will point out, which is another change in the standard, is the accounting for real estate tax, executory costs such as real estate taxes, insurance, are today considered part of the lease payments, but in the standard, in the new standard, they are considered part of the lease payments, and the principle behind that is that the real estate taxes, insurance, and associated expenses aren't considered services provided to the lessee. So when the associated costs don't relate to goods or services provided to the lessee outside of the lease arrangement, then those are non-lease components will be counted accordingly. So what the standard has you do is identify what those are and then allocate, okay? You allocate the lease components and the non-lease components. And what it does, it provides for an allocation methodology. So the lessors would follow topic 606, and let me stop on that point right there. And we'll talk about the effective dates related to the standards when we get to the end, but there is a year difference between the RevRec date and the adoption of the lease accounting. The RevRec date being 1 year earlier than the lease accounting date. And so as it relates to lessors, you want to be careful if you're adopting the RevRec standard and the lease standard. The RevRec standard does have a 1 year early adoption period, but the lease standard you can early adopt for those folks that are brave and want to do so. The point in me bringing that up now is that when you're allocating the non-lease components, all right, you allocate the components in accordance with topic 606, which is the new RevRec standard, and you follow that methodology, and then you account for those non-lease components in accordance with other GAAP. Now, to the extent those are goods or services that you're providing, those non-lease components may very well fall within the new RevRec standard. So what we're advising some of our clients to do, and in fact, we're working on a big RevRec project right now where we've suggested that the company consider adopting the RevRec and the lease standard at the same date. So we certainly encourage lessors to take that option. On the lessee side, what you would do is use observable standalone prices. Okay, what if the lessor were to provide a similar service product, and you can determine what the standalone selling price is of that product or service, that would be the preferable method. And we'd encourage, obviously, to use the maximized observable inputs to the extent you can in determining what the allocation should be. If they're not, then you would estimate what those standalone sales prices would be. And again, to the extent this becomes problematic in determining whether those non-lease components are then, or the standalone prices of those non-lease components, you certainly can apply the practical expedient. But again, highlighting the fact that you need to really maximize the use of observable information to the extent you can related to determining how that allocation should be applied between the lease and non-lease components. The lease term. Now, I will say this, and James, I don't know if you guys have heard this. I'd be curious to get your thoughts. At the end of the day, there's been a lot of deliberation about, over the course of the lease project, on determining what the lease term should be. At the first ED, you're taking a probability weighted approach and determining what that, considering renewal options. And a lot of folks found that, including me, problematic. But what it came down to is something identical or very similar to what we have today, but we use in today's standard reasonably assured. So if you look at the beginning of a lease term and you're evaluating whether or not you're going to exercise purchase options, you need to determine whether it's reasonably certain that you'll exercise those purchase options. Now, I will say what I've heard, I think there are some folks out there that are seem to be lowering that bar related to those purchase options. And my comment to that is you generally would come up with the same conclusion that you came up with today in today's standard although the terminology has changed, the bar is still very high in exercising that option. Have you guys heard anything on that, James? Or
not really. Kind of similar to what you're kind of sharing with me here.
Mm-hmm. Yeah, I think that if you're looking at a 10-year lease, you know, and say you get 2 5-year renewal options, I would say that it would be very difficult to determine at that point in time whether you're going to exercise a 5-year. Marriages don't last 10 years, so I could say it's probably even as difficult to determine if you're going to exercise a 5-year renewal option. Now, I will say that there's no, which was in, I think it was an ED2, definitely an ED1, where there was required reassessments along the way. And I think what you do have to be cognizant of, and those aren't required in this standard, unless there's evidence that comes up that there is evidence that you will exercise a renewal option. Let me give a very simple example in real estate. If the lessee gets into year 7 of that 10-year lease, and they start hammering away on some improvements, okay, and if those improvements, the cost is clearly not recoverable over a 3-year period, then you could very well hit that threshold and make the determination that now we need to include that renewal option in our lease arrangement. So again, just caution those that today's guidance is very, very similar to what you'll see in the new guidance related to the lease terms.
Okay, we've arrived at our first polling question. When you look at the question on your screen, you can see the polling question: how much impact will the changes to lease regulations have on your organization? And there are 3 options for you to choose from. It'll have little impact, it'll be of moderate impact, or it will have a large impact on your organization. So look at your options, and we'll give people a minute to select which of those seems most appropriate for their organization, and in just a second we'll look at what the response is. I can already see we have a leader, but rather than bias your answers, yeah. I won't say what it is yet. So go ahead and choose your answer to that question. And again, if you're seeking CPE credit for today's event, you do have to answer all of the polling questions. So we'll give everybody just a couple more seconds to get their answers in. It looks like the answers are slowing down. So what do you think, Sean? Have we given them long enough to answer?
Yeah, it looks like things are stopped moving.
All right. So now we'll close out the poll. And the answer is that the majority of you, 52%, said this will be of moderate impact, 36% said little impact, and 12% of you unfortunately did say that this will have a large impact on your organization.
Yeah, and I'll be willing to bet this is probably driven off of what we've seen anyway, the number of leases that an entity may have and how this the impact of the standard will be adopted. And I assume that's what that's driven off of, because quite the contrary, that questions that I've gotten are the concern on the liability hitting the balance sheet and what folks like you, James, are going to.
How are we going to react?
How you're going to react to that? Yeah, exactly. So that's kind of what we're wondering what that's going to look like, especially when you're entering into lease arrangements now, okay? And those lease arrangements, especially longer term, will impact a company when this lease standard becomes effective, okay? And so one of the things that we're telling clients anyway, when it comes to lease arrangements and debt arrangements, that they're proactive in running the numbers. So you have very few leases, that's easier. And obviously, the more leases you have, the more cumbersome that is, because what I think could be an issue with entities that have a lot of leases, operating leases, are inventory those leases, because and I'm not afraid to say this as an auditor, there's sometimes a lack of focus associated with the notes to the financial statements by preparers, and then even sometimes auditors that I've seen. And that was certainly an issue that we discussed within the Technical Issues Committee, what the impact that would have, because the board was asking us the concerns around non-public, around obviously the debt covenants and things like that. So,
well, I think it's important, if you're entering into any kind of lease contract or even a financial facility that's going to go through the duration of its implementation, the time period, I think you need to have that conversation early with your lender on exactly the impact that you think this will have on those financial covenants that will be in that facility.
Let me ask you this, because I'd say more times than not, or more times I care to admit anyway, I wonder sometimes if clients understand their covenants. Do you see that on your end?
Yes, we do. So one big thing you need to do is understand how it's calculated. Now, for most clients that have covenants, they complete a covenant certificate, compliance certificate. So if you have quarterly covenants, you're doing that on a quarterly basis or an annual basis. But you need to make sure you understand how those are calculated. How does your bank design liabilities? How does your bank define funded debt? How does your bank define senior debt? And how do they calculate your EBITDA? Is it a 12-month trailing EBITDA? Is it just an annual EBITDA? Understand those things and how that it will impact you.
Yeah, yeah. Do you have any of your clients already, you think, going through the adoption process? Do you know yet? Have you seen anybody when they're negotiating their debt, hey, how is this going to impact me, or present financial statements to you with the impact?
Not yet. Actually, we've been fortunate. We were actually bringing it to our clients' attention early and having conversations with them, let them know it's out here, getting them involved with the webinar like today, and also some of the other things we can do to educate them. And then they're going back to their CPA asking, what happens? How is this going to impact me? So the sooner we get into these conversations, the better. I do think, though, they'll probably accelerate a little bit conversations, because now you're right up on a 2 or 3 year facility could really impact you. Engaging in a 2 to 3 year facility can impact you on the covenants, because it will go over the duration of this period of the implementation. So I think it's important now, especially next year when we're going to 2017, if you're engaging in a new contract, you probably need to have that conversation sooner than later.
Yeah. Yeah, one thing that we're concerned with is more on the non-public and probably the non-accelerated filer side, is you got two major standards being with that year apart effective dates, right? And this is for topic for discussion, another webinar related to our revenue recognition webinar we'll be hosting, but that is major. So when you got two standards like this, can have major financial impacts just a year off of each other. That's why we're trying to push companies to look at both now and not wait. With this, assessing the impact from an asset and liability side, and then on the revenue side, going through the 5 steps. And even if you've got simple revenue arrangements, and determining the impact of, because the devil is in the details on that side, and sometimes here too, related to the lease accounting side. And then highlighting the fact when you have U.S. GAAP issuers with subsidiaries abroad that are reporting under IFRS, or a local GAAP that's impacted by IFRS, that you've got conversion adjustments ahead of you related to determining those operating leases that, like I said, for IFRS, they're all finance leases. All right? Let's get in the fun part, the lease classification. Just to take a step back for a minute so you understand the criteria, it looks very familiar to what we're accustomed to today, and we'll talk about the new criteria added in a minute. But when you look at the underscored major part, substantially all, you see those bright lines going on. I think most folks are now familiar with that, or at least know that that was taken out of the IAS 17 book on IFRS, or lease complement and IFRS document, that, and got rid of the bright line approaches. And so the boards really tried to, or at least the FASB did, because the ISB was already there in its current document, really wanted to stick with the principles-based approach in determining whether you have a finance or operating lease. Okay, they really tried to stick hard to that concept, and to some degree they did, and there's more on that in a minute. But so what they did was they retained, for the most part, the principles of those core criteria, where the lease term is a major part of the remaining economic life of the underlying asset. And then, of course, the present value of the lease payments, or at least substantially all, are equal to the fair value of the asset. And of course, again, remember the 75 and 90% tests. And those two tests, there certainly was a lot of room for structuring going on in these lease arrangements. We'll talk about the rates that you'll apply in a minute, which is similar to today's accounting, but where we really saw errors were in determining whether, under today's standards, you have a capital or an operating lease, is the incorrect rate being used, okay, in the way of an incremental borrowing rate. More on that in a minute. And we've seen many times where, when you apply the correct rate, you shift it from an operating capital lease. So there's a lot of tensions there in structuring. So one of the reasons of others that the board wanted to stay away from that was to really look at the principles of what the arrangement you were entering into, and certainly their deliberations from when they were calling Type A to Type B, and now finance to operating, really based on those principles. And I think that's what they tried to stick to. Of course, you are familiar with the transfer of title, transfer ownership at the end of the lease. Certainly would get you there like it does now. And then was recently certain to exercise what we call now a bargain purchase option to purchase the asset at the end of the lease. One more comment before we get to the new criterion is that one thing you don't see up there is the old 25% test, or when you enter into, you don't have to see 25% test, where right now when you're in the lease the last 25% of the asset's life, then you're out of it, okay? And so what you saw is then they added the criteria. If you enter near, of course, near the end of the underlying life, and of course no bright line being there for the 25%. They did add a new criterion, that the underlying asset is such a specific nature that when that asset's returned to the lessor, there's really no alternative future use of that asset to the lessor. And if you think about that for a minute, at face value, you go, wow, how do I determine that? And sometimes it's easier if the lessor constructed that asset for you, and a lot of times that would be the case if you have a specified asset. But back when the boards were deliberating FAS 13, they talked about this, and the reason they did not include it in FAS 13, and by the way, IFRS did include it in their standard, was that they felt like if the economics of those transactions would be where if you had the lessor constructing an asset or delivering an asset that was so specialized in nature to the lessee, and there's no economic benefit after the lease term, that you're going to flunk the 90% test anyway, okay? You're going to flunk the 75% test probably anyway. So point being is, in my personal view, that that's not a major issue. You probably will be flunking another test before you even get to this one. So it kind of, the economics align with the substantially all or major part tests that are part of this this determination. Okay, so you run through the criteria of the finance lease, determine whether or not you pass or fail. Again, similar to today's accounting, and if If you don't flunk one of those tests, and of course everything else is an operating lease. And just jumping ahead a minute, and the interesting part is certainly obviously looking through these principles, one, but two, the day two accounting, which we'll talk about in a minute. If you're booking something on the balance sheet, how do you retain straight line accounting related to the lease expense? So James, this is what we're doing. So yeah, those numbers in your 5 or 6, you can probably throw that out the window.
Okay.
Any concerns with this? When I first saw this, my concern, I've seen it on the IFRS side many times, was that structuring going on, or still trying to massage the principles, okay, where you say have a private equity firm that cares more about EBITDA and less about leverage potentially, and structuring lease arrangements that either fall with that. Right, exactly, and stretching those principles a little bit on whether you're consuming most of the benefit of that asset or not. That was my concern associated with these 4 tests. So the board caved in at the end. They really caved in at the end. They said, well, I'll tell you what, we get that there could be issues around the principles, but we want you to focus on the principles. However, we don't have an issue, and we think it's a reasonable approach to apply the 90 and 75% test. Okay? So you can replace the substantially all and major part 75, substantially all with 90% test. And we'll pop back into 25% criteria related to asset life. So they said, you know what, Linus, you get your blanket back. Okay? You really can use these if you want, and it's reasonable. However, the focus is on the principles of the criteria that we previously discussed. Now, what I think you'll probably see is practice continue, okay? And we don't know what that's going to look like yet, okay? There are varying opinions around that, but I'm of the opinion that practice probably won't change much and still seem to hover around these percentages. You could have firms that take a guilty until proven innocent approach. If you're hitting 70% of that life, tell me why it's not a finance lease, okay? I'm not saying that's going to happen, but that could be an issue. So in my personal view, I think preparers will hover around these bright lines. I've even seen policies on the IFRS side, companies adopting policies with these bright lines in it, so at least they can apply the principles consistently over time to its lease arrangements. So James, you could still come up with the same answer today or tomorrow than you did today related to the classification lease. Now, some of the concerns are, well, okay, you've got to finance an operating lease. We've got to bring these operating leases on the balance sheet. How are we characterizing the balance sheet and the income statement? So that we'll talk about, but let me jump ahead a little bit for you. So in short, the operating lease will be, okay, you determine you got an operating lease in the new standard, right? Those are going to be operating liabilities, okay? And then obviously the financial liabilities can be characterized such the statement of cash flows. So how do you guys look at that? Maybe I'm getting ahead. I know you're going to talk about covenants later, but if I'm getting ahead, tell me. But what is that? How do you guys look at that now? Is that how your are they operating liabilities when you're looking at the notes when we talk about before and bringing these on? So give me some transparency process now to process then maybe. And if I know you're going to talk about debt covenants later, but just real high level.
Well, we may look at an implied leverage when it comes to a operating lease, because again, it's not on the balance sheet, but we'll take a factor of the annual lease payments as discussed earlier times a certain year amount of time, and that gives us an implied leverage. Now, that's not embedded in your financial covenant today. That is something that we use just during our underwriting process to see because at the end of the day, you have to execute that lease. You have to make those payments. So that's still a form of debt that has to be executed for the business to operate. Mm-hmm. And so we do an applied leverage today. What this will do now is give probably a standard for everyone, because the accountants are going to give us that actual true number. So it's not, if we multiply the annual lease expense times 5 or 7, we'll have a hard number that will show up on the balance sheet. And that gives us something to work with.
Mm-hmm. Got you. Let me ask you this. So still probably getting ahead on adoption. I'll make sure we have time to discuss this. You know, one concern is that, okay, well, the day of adoption, I've got a debt agreement, right? I've got these covenants, and now I've got these liabilities popping up, and I'm out of covenant. Okay, so what are financial institutions doing about that? Have y'all been thinking about that for a while, or what?
We have.
Because I sometimes see clients that have that gap exception in there, and not all financial debt arrangements have that.
And we'll talk about that when we get into the covenant portion. Mm-hmm. But yes, but you have to remember, this has been out here for a long time. So you get ready, it keeps changing. Yeah. And so really it goes back to the chicken and the egg scenario. You really don't know what you have until those numbers are on the balance sheet to set a target. So if you got a 4-to-1 ratio, you really don't know what that's going to look like until you make the adjustments to the balance sheet. However, I will say this, probably what you'll start seeing is banks putting some kind of language in the loan agreement that'll be subject to change or revision due to changes in GAAP, accounting reporting, et cetera. So there'll be some options out there where a bank shouldn't call someone in default because of a GAAP change on the accounting rules.
Okay. So not a major concern on adoption when these, or am I just not interpreting?
It could be. It could be. So think about this: if you're going to a 3-year facility next year, or a 4-year facility next year, you've got covenants and documents already drawn up, and if you didn't include any of this language, you have to redo those loan agreements, which could cut in the cost. Mm-hmm. Say if you had a syndicated deal with multiple banks and that, you get into a lot of cost of that. So if you can prevent that on the front end, or get an idea of what you think it could be, or put just some protective language in there that it's subject to the changes, then you're fine.
Right. Okay. Thank you for that. I'll go ahead and answer a couple of these questions. One, I'll try to read this here. As a lessee, we include real estate tax, insurance, and the payment for calculation of the liability. That's currently. However, for capital lease, do we exclude the cost of the maintenance component? When you're considering non-lease components, okay, you get down to the lease component, and this is for lessor and lessee, okay, you're looking at, okay, I've got non-lease components, got lease components, okay, and this is where I think it's important to be familiar with the RevRec standard. You're going to have to get familiar with it anyway, okay, because in the RevRec standard they talk about promised goods or services that are delivered, all right, so you got to look at the principle whether you've got promised goods or services within that context of that agreement, okay? Again, the whole contract itself may not be, okay, the entire contract may not be a lease, all right? You may have an embedded lease in that, okay? So and my point in bringing that up is you could have all types of things tied up in a payment, okay? That may look like a service arrangement, okay, but you've got one payment for services, and there may be an asset delivered, okay, along with those services. So one is you have to see if that asset, okay, qualifies for a lease first, okay. Again, one payment, and then determine what are the promised goods or services outside of that asset that we'll say in this example qualifies for a lease, okay, and then you carve those out. Anything else that's not a promised good or service is included, like real estate taxes, like insurance is a good example, okay? The lessor is just trying to protect their rights, or protect the asset, okay? So they're not necessarily providing a good or a service, but it's an asset protection thing, all right? So that's how you have to look at components in a contract related to lease arrangements, and that may not always be straightforward, but you got to think about, even if you're a lessee, you think about what's the lessor providing me, okay? Providing me an asset, all right? Provide me these promised goods or services, or they're paying things for me, okay? So think about it from that perspective. That's why I encourage everyone to get familiar with the RevRec standard, because it talks about these concepts within the revenue standard, and I think that's really important. Hopefully that answers the question. If the lease starts near the end of the economic life, would be considered a finance lease? No, and again, you can look at the 25% test. So at the end of the day, you're very similar to where you are now, okay, in the accounting. So if you're entering into that lease at the end of the arrangement, okay, and you fall within that 25%, you got an operating. You're out of finance lease accounting, okay. I think you're good. Those are good questions, and I'll again emphasize the devil does sometimes get into the details, because I'll reemphasize the fact that I made earlier on these contracts with embedded lease arrangements. Again, I've seen them sometimes largely ignored because currently the result's the same in the P&L, but now you've got to determine whether you've got assets and liabilities that belong on the balance sheet or not, and a lot more attention will need to be paid to those types of arrangements. All right. Okay. Initial measurement. Very similar to what you've seen today. If you look at, we'll call it a capital lease. Okay. Again, refer to a finance lease in the new standard, topic 842. So you're determining what the present value of the payments are. So we talked about the payment stream, right? So you got a 10-year lease. You allocated your non-lease components out. Okay. We'll say those fall within the RevRec standard. All right. So you got those out. Now you're down to your core lease payment. Okay. And now you'll take that core lease payment and you're going to discount it back. Okay, over the term of the lease. All right, we talked about the term of the lease. Very similar to what you're doing today when you have a capital lease. All right. So what you will use is a rate, the rate that's implicit in the lease. Okay. Or if that's not known, the incremental borrowing rate. Now, my experience is that's rarely known. The lease the rate that's implicit in the lease. I've seen people try to calculate such. And this is where things get a little south, is determining what that rate is. So generally, you're going to be using the incremental borrowing rate, in my opinion. All right. And again, the nature of that will not change. It's not changing from FAS 13 to topic 842. So I just will caution people, again, standard's not changing in that regards on what the incremental borrowing rate is, but be sure you're using the appropriate rate, because that rate needs to be commensurate with what the lease term is. Okay, if you were to go out and finance the asset from James, all right, and you go, okay, James, I'm leasing this 10-year asset. Okay, 10 years. The lessee's guaranteed the lease payments. Okay, it's a piece of machinery, and obviously that machine's collateral for that. So I'd go to James and say, James, what would be the rate that you give me on a term loan with those terms? Okay, so that's the rate that needs to be used. I've seen line of credit rates on lines of credit that are variable, okay, secured by something different, applied to a lease payment, okay, determining what the present value, determining what the liability is, okay, when the lease payments are fixed. All right, so terms just aren't commensurate with the lease term. So I caution folks on that. Now, there have been arguments that sometimes that's hard to get, okay, and the board realized that. So all in its infinite wisdom, they said, okay, we're going to give you some relief, okay. This is one thing they said. They've got a project going on right now, trying to simplify some quick hits in accounting, and we always say buyer beware when you're trying to simplify something, the underlying resolve. Okay, look at the debt classification project. If you don't believe me there, go take a look at that project where we could potentially end up on that. This rate thing is no different. So what they said was, you can use, okay, as a policy election, a risk-free discount. This is non-publics, by the way, only, not public companies or issuers. There's non-publics. You can use a risk-free discount rate, okay? Forget going to James and figuring out what your borrowing rate is, incremental borrowing rate. So, okay, you can go on Google, you can figure out what the commensurate risk-free rate is for that lease. use that. Now here's where the buyer beware thing comes in. You want something simple, understand the results. What is that? What's that going to be, James? You're an interest rate guy, you know. It's a lower rate. Lower rate leads to a higher liability, okay? So understand the implications of selecting a simplification, okay? So, but that is available to non-public companies if they want to use that practical expedient in doing that. Right of use asset, okay, so you calculate the liability, right? $2 million, whatever the number is, okay? Right of use asset is the debit, okay? There are some reductions for direct leasing costs, but for the most part, they're going to be the same, okay, on day one. So generally, it's going to be the same as liability, and generally, you're like your capital lease accounting today, okay? So even in your operating leases, okay, you're going to determine what that is and book it. So day one accounting for operating finance leases, you'll come up with the same number, okay? Where the operating finance lease come in are the day two accounting, okay? And what the expense, how the expense is accounted for, and how it's characterized in the P&L. And if you remember what I said earlier, folks got up in arms about treating all leases, okay, as capital leases. A lot of folks do not want that accounting, okay? Why? Because it's front-loading your expense, right, in the way of amortization and interest. All right? So now what they want is we like the P&L. We like operating lease accounting. You're straight lining your rent generally or based on the use of the asset. So that's what you see.
So basically, Sean, I just want to make sure we understand that everyone understands this. We're not really impacting the equity position day one. We're just adding an asset and a liability that will.
So I've got it right. I enter into a lease arrangement, right, on day one. Okay? I book, forget if it's a finance or operating lease. I run through my calculation, determine what my liability is, $2 million. Forget other leasing costs, forget everything else, okay? I debit asset for $2 million, it's called a right of use asset, okay? And I credit the liability. So day one, we're good, okay? Now, day two is where it gets interesting. And when I say interesting, I don't mean the effects. I mean how you come up with the operating lease number, okay? And we're going to walk through an example on that in a minute. So your income statement, there should not be a significant impact or little impact, if any, related to the income statement associated with the lease expense. So yeah, when it comes to equity, obviously, for the most part, should remain untouched, associated with entering into a new lease arrangement in the new standard. So that was probably a covenant question, I'm sure. That's where your mind was going. I saw it. Great. All right. Let's talk about day two. This is where, and remember what I said related to operating lease, and I'm gonna go over I'm gonna try to articulate what that is, okay? But again, I think the devil's in the details of how you come up with that. And I'm gonna give you some more background on it, which I think is important. So the finance lease, okay? Right of use asset, all right? Classified within, property, plant, equipment separate on the balance sheet, what have you. Long-term asset, subject to impairment testing, all that good stuff. Okay? So again, very similar to today's capital lease accounting. Then you're getting into the amortization, the unwinding on a finance lease anyway, amortizing that over the asset's life of the term. Okay? Now, that's similar to what you see in capital lease accounting, not much different. Operating lease, okay? Operating lease is a little different, okay? Because we have deferred rent, some other lease-related assets, okay? But now, all those are being characterized as assets and liabilities. So day one, you booked your $2 million asset and liability. So the first thing you want to think of is, well, how do I unwind that? Okay, how do I unwind that? And the asset on the operating lease side is not going to be amortized, okay? But you will unwind the asset. So that's when we get into what the lease liability looks like, okay? So finance lease liability, again, the same, okay? You're going to unwind that liability. Similar, you didn't recognize your interest expense, okay? You're, like I said earlier, amortized right use asset. Well, not necessarily the case with the lease liability and the right of use asset, okay? What in a sense you're doing is you're unwinding the liability, and this didn't make sense to me, and that's why I've got the example in here. You're unwinding the liability to the P&L, and you're calling it rent expense. Okay, so you're unwinding the liability to the P&L, and you're getting to the straight. Let's say the $2 million asset liability. I'm about to confuse everyone, so beware. So you're unwinding the asset liability. Let's say if you had the 10-year lease, you came with $2 million of liability. We'll call it $1 million asset liability. You've got $120,000 of rent per year over the 10-year straight line, okay? So into year one, you're going to recognize the $120,000 expense in your P&L, right? Because you're recognizing straight line rent expense, okay, for the operating lease. So you unwind that liability, okay, through the calculation or through your amortization of the liability from your amortization table. You unwind that, okay, and then you're, in a sense, your asset's going to be a plug. All right, and you go, whoa, what does that mean? And that's why I got an example. And so when we met with the boards and they were going over the resolution, by the way, FBI came up with this model. I think IMA did too. They came up with this model where they said, okay, this may not make sense. Okay, this is what I'm thinking if I'm FBI. This may not make sense, but there are two things that everybody wants, or at least one thing everybody wants. Two, that they're going to live with, and that's a liability, right? Two, that's got to go on the balance sheet. We've got a straight line rent expense. How do you do that? Okay, well, you calculate what that should be. You unwind your operating your operating lease accounts, okay, into the asset and liability, okay, and you achieve straight line accounting. That makes no sense, which is why we have an example, okay, in the, so before we go, let's go back to the previous slide because everybody's going to try to study this. I want to make a couple comments before we do this, okay? One issue going through the whole deliberation process was related to, we need something that's operational, okay? Because what the boards were proposing on the operating lease side were complex, okay? Complex didn't make sense, and they were, when they got past, okay, we're good with two models, okay? We get the real estate world that's driving the straight line accounting and others. We think, for most, not all board members, but we get maybe these are two separate types of arrangements, a financial arrangement, non-financing arrangement, okay? So we get that, all right? So what we're going to do is, and what FBI came up with, is something that we feel like will not make your life more difficult when you implement and it's operational, okay? And you go, well, how the heck do I do that? I don't understand what you just told me on how you account for it and get the straight line accounting. So that's when we get into the example. Let me show you what I mean by that, okay? I call it, this is my term, a top-side approach, okay? And for those of you that do consolidation accounting, you know what that means, all right? So you're booking a top-side entry. So let's say day one, you've got an asset and liability, right? You determine what your asset and liability is, all right? So you might recognize the schedule because a lot of you may use Excel in tracking your lease arrangement. So this is probably something you give your auditor, say, here's my 5-year commitment schedule and thereafter, okay? So if you notice, you've got the lease going from left to right, the lease, the commencement date discount rate, all right? Then you've got the years those lease payments are due, All right, so that's probably something you normally see, notwithstanding you probably don't normally put the commencement discount rate in because you don't need it for current accounting because these are your operating leases. All right, they said, well, you know what, all you really need to do is, okay, in their infinite wisdom, is that insert a column and call it lease commencement date discount rate. Drop those bad boys in, and then at the end calculate what your liability is. Okay, that's the only step we think you need to do. You go, well, how's that? So let's just think about this for a minute. They said you can continue your operating lease accounting. And by the way, this is not the standard. You do not have to account for it like this. When I say this does not need to be your process, okay, this is just a suggestion process. But at the end of the day, you have to put the asset and liability on the balance sheet, and you're going to straight line your rent. I tend to think this is the easiest approach personally. Okay, so let's say you sign a lease on January 1st. All right, you calculate what the asset and liability is. You have increasing lease payments over the term of the lease, or you got a rent holiday, what have you. Okay, you don't have flat rental payments. So let's say you're reporting Q1. All right, so you've determined what your asset and liability is, but you've booked nothing yet. So in Q1, you continue to book up your deferred rent. Well, let's just say there's deferred rent. Ignore the numbers and the categories on this example. Just walking through the theory. So what you do is, okay, you continue booking your deferred rent. Okay, month one, you're making monthly payments. Month one, month two, month three, or your in the holiday period. So month one, month two, month three. And you're booking up your deferred rent. You've booked no asset liability yet, then you've got to report to the public, right? So at the end of Q1, okay, you pull the asset and liability off your schedule, okay? I'm sorry, the liability off your schedule, and you book it. And you unwind, on March 31st, you unwind your deferred rent, or if you have prepaid rent, you unwind that into your accounting entry, okay? So March 31st, you're booking this top side entry to get the asset and liability on the balance sheet. You've done nothing to the P&L. Why? Because you've been straight lining your rent expense all along. You've been calling it rent expense. Okay? You've not touched the P&L. You don't need to touch the P&L. Okay? April 1st, you post a reversing entry, and you put it back to where it was. You're booking an entry, a topside entry, March 31st, April 1, you're just reversing that entry. And you continue with your operating lease accounting until such a time you have to report to the public, report to your investors, third parties, what have you. Okay? Now, in my view, this seems like a fairly simple approach. But I will caution you, the more leases you have, the bigger the schedule is and the bigger mess this could become in forming those calculations. Now, I assume in the software world, we get a lot of calls from leasing agent software folks that want to partner up with us in articulating this because they're trying to sell software that tracks their leases. And so I know they're working on this, and they may have software out that can perform these calculations. I don't know that yet. I'm out. So the point being is, this is probably the best way to get the asset liability on your balance sheet and not disturb some of your processes of control until you have in place. Notwithstanding that, you may have to add certain processes to get information because these used to fall in your notes like we talked about, James, and maybe there wasn't the focus that there needed to be in determining where all your assets are in lease arrangements and such, because you got a lot of them. That may be cars, vehicles, or other things that are out across the U.S. or internationally, of process of controls that need to be put in place to gather all this information, okay, to put this schedule together, to get it into the software, what have you, okay? So obviously on the capital lease side, it's very similar. You can put the asset in your fixed asset software, calculate the amortization relatively easy, and use your T-value or something to determine what your liability is. But this is the thing that I had the hardest time in figuring out is where I saw the example, was how you unwind the asset liability of the P&L. You're really in a sense, there's not a direct correlation like you would think with like the capital lease as you unwind your asset liability. Is that clear as mud, James, you think?
Very clear.
Yeah, I'm sure it is. But you don't have to book it, you just get to criticize it.
That's right.
Yeah. So anyway, again, the boards or the board, because this is not an IFRS, so our board, the FASB, we're trying to make this operational as possible and get the intended result, which is straight lining the rent expense associated with operating leases while retaining the asset liability treatment on the balance sheet. This is what they ultimately came up with. Now, a question I do get a lot and continue to get is, what about the non-publics? Are they going to do anything about this? I will say Billy Atkins and the PCC, as well as some folks on our committee, pushed the boards for a private company exclusion under that, related to, hey, why don't we just stick with what we have now? Banks have good information. They feel like they've got the appropriate information in the notes, and the preparers are giving them that information to make useful decisions. So they are giving them decision useful financial statements. That did continue, and the PCC's done fighting it. The problem is the board kept coming back saying, if you can talk me out of this being a liability, I get it. But banks are telling us they want this information. Okay. So again, if users are telling us, which are predominant driver of standard setting, what users want, that's what they wanted. Okay, that's what they wanted. So for the non-public, this is here to stay. This is not going anywhere. So anyway, I don't know if I know people hear rumors that those things around, hey, maybe in the non-public world it's not going to be an issue, but it is an issue and it's not going anywhere. So I'm confident on that. I've been involved in those discussions. So. All right. And I'm sure, I'm quite confident you may not 100% gotten that. I get it. It is conceptually hard to think about assets and liabilities unwinding to the P&L. But if you think about it like this, okay, a day one calculation, don't book anything, and then when you externally continue in your GL, okay, what I would do is, in certain instances, is have a GL account, my asset liability, and it's zero, okay, until I report to the public, report to my bank or my investors, and I pull it off my spreadsheet, right, and I reverse my operating lease balance sheet accounts, okay, I reverse those and book the asset liability. So if that happens on March 31st, and then April 1, I reverse back. I continue during the period with my operating lease accounts, and then again when I report, I go do this again. It does seem a fairly simplified approach, but one will see when you actually put this in practice. And again, just to clarify, that's not in the standard on how you or this approach is not in the standard, but the straight line rent accounting and the unwind lease liability are. All right.
All right, we have reached our second polling question. My apologies to those of you who were trying to answer before we went live with the polling question. So you should see on your screen, how is your organization currently tracking leases? And your options are, we're using Excel, the classic option we all use. We're using a third-party lease administration software. You're using a combination of Excel and lease administration software, or not really sure exactly how we're tracking that. So go ahead and choose your option. And again, if you're seeking CPE credit for today's event, you do need to answer all the polling questions. And we're going to wait a little while. We can see how many people have responded. So we'll give everybody a chance to choose their option there.
Not a surprising result.
Yes, you can see the answers rolling in, and I don't think anybody's really going to be surprised at the answer.
Yeah, and of course, this is exactly what we see, and we'll tell you the results in a minute. So, the national firms have webcasts as well, and generally, I think this question's asked and gives us one of the questions I would ask, are you going to continue doing that? Will you continue to use that method to account for your leases? I suspect that number will drop, but the leasing folks aren't out there, but on the software side, but maybe there's more of a combination of software.
Maybe. All right, so let's leave it open so that people can answer for a second, but we do have the results are in. 74% answered good old Excel. That's how people tend to track just about everything. It's amazing. And then 6% are using a third-party lease administration software. 13% are using a combination of Excel and software, and 6% are not sure. It must be somebody else who's keeping track of that.
All right. As an auditor, I'll give a comment to that. So just beware on when you're using Excel that, this is my personal opinion, not necessarily my firm's or my network's, but there will be more attention paid to this Excel schedule in the controls around it, okay? So be sure you've got the appropriate controls in place if you're going to stick with this method, okay? Again, we're going from notes to financial statements or balance sheet P&L. There will be more attention paid to where this data comes from, how it's calculated, the controls around the software or the Excel schedule used or what have you. So just be aware if you continue doing that. Last thing you want are control deficiencies reported, because the adoption of new standard and you do not pay attention to controls and processes that you had or needed to put in place and did not do so when you adopt the standard. So I will throw that out there. All right. Let's talk about short-term leases real quick. As I mentioned before, the adoption standard will put a majority of leases on the balance sheet. This is one where the boards batted around a lot and trying to figure out how they put a fence around 12-month leases. It was always 12 months. Of course, other terms we'll talk about, but for the most part, throughout the deliberations, they stuck with terms related to 12 months or less. That didn't really change. What did change was trying to figure out how you define the lease term and the correlation between this and the 12-month lease criterion. And so there were modifications along the way because there were at times where the term definition threw out even like month-to-month leases, you know, that maybe reset every month, evergreen or what have you. So the board took a hard look at that and said, you know what, and firmed up what the lease term was. So if you look at, for example, that month-to-month lease, you know, in your, you're in month one, right, and you're trying to validate whether or not you fall within this exception. So you're looking at your renewable terms, which you want to assure yourself it's not reasonably certain that you're going to exercise your 11 extension options, if that makes sense. So what they came up with was this the definition of lease term, which I think more favorably fit short-term leases that they intended to fit within this bucket. So the policy lesson, of course, is if you adopt this, then your 12-month lease accounting, you're out of the whole finance lease considerations, and you're just accounting for on a straight line basis, and you've got no asset or liability associated with the lease. So really simplifies things there for your short-term leases. Now, this is where I normally get a question on related party leases. You know, as you know, and the bigger concern for non-publics, when you've got related party leases, you know, dads leasing from brothers or common control type deals where you're not consolidating the leasing arrangement. You follow the PCCL term, what have you. So how when you have these short-term leases and you've got an arrangement, whether that's contractual or not, and a lot of times they're not contractual because you've got, I think, James, you may have asked me about this before, where you've got shareholder group that owns company A and company B, Company A's OpCo, Company B's real estate code. Right. So you're not consolidating under 1046R. We'll leave that out of the equation, of course. And then the question is, how do I evaluate that lease? So right now, it's a substance over form evaluation. The board's batted that around quite a bit, and what they ultimately concluded is what's legally enforceable between the OpCo and the real estate code. Okay. And if you don't have a contract, then you turn and look at what's legally enforceable, and you quite favorably could be within the short-term exception. But so that's a change in the current accounting in evaluating your related party leases and determining whether you're not a finance lease, operating lease, do you fall within the 12-month exception or not. And I'm sure, I know as an auditor, I see a lot of those things aren't papered up or what have you.
And later in the presentation, we'll give it a similar example of that.
Oh, you got, okay, good. So yeah, I imagine you guys like to see those things papered up, of course. Anyway, all right. Let's real quickly talk about the lessor model. Like I said, not a lot changed other than the potential classification of sales type or direct financing, where you don't have to really have profit recognition on sales, profit in the transaction for sales, at least accounting. But at the end of the day, what the boards did was, and this went, and I know the real estate world was up in arms with the previously proposed models related to the on the lessor side, and I think it was the receivable and residual approach, where if you had, and this was in, I believe, ED2, where you had, say, a commercial building, you got 10 floors, there are at least 10 different tenants, where you were pulling out the floors as you leased them to your tenants, and everyone, including me, didn't think that made sense. I was giving a presentation on that. A lot of real estate folks in the presentation were really, really upset about that. And so what the boards ultimately concluded, and let me step back. What the issue around this was, when they started addressing lease accounting, it was a lessee-only deal, and they were working with the ISB. And the problem, they were trying to create symmetrical models between the lessee and lessor. In the lessee model, they were screwing up, which was screwing up the lessor model, and it was really problematic. But at the beginning, it's a lessee deal, and then for just months where they issued ED1, they threw in the lessor model, and it was ugly. And so, in my personal view, I don't think enough thought was put to that. I'm sure the board will disagree with that, but given what they came up with, I think I'm right on that. So, what ultimately happened was boards came around and said, you know what, the lessor model, for the most part, we're happy with. And so I think, especially those in real estate world, are happy with the conclusions that the boards reached related to the lessor accounting. But again, couldn't harp enough on the RevRec standard and how that applies to the real estate world. There's some other things coming that I'll do a sidebar on, definition of business, which will obviously make a lot of folks happy, where they're narrowing that scope. And then there's names out on other income and the transfers of non-financial and in substance non-financial assets, how those are accounted for when you're not transferring a business, okay, you're transferring non-financial assets. That's a big deal in the real estate world. So another credence to get on this now, as you should, the topic 606 and the comment period is done on that other income document. So keep an eye out for a final stand on that as well. All right.
All right, we've reached time for our next to last polling question. So you should see on your screen, and we're about to open up the question: which of the following do you believe will be the most challenging when implementing the new lease standard? And so choose from amongst your options there. Do you think it'll be most challenging to compile an inventory of lease information? Do you think the hardest part will be implementing new processes and procedures to comply? Do you think it won't be challenging or presents no significant changes other than the accounting side of it? Or are you not sure? So go ahead and pick your answer, and we'll give everybody a minute. Again, one more reminder, if you're seeking CPE, you do need to answer all 4 of the polling questions today.
It's a smart group. think we have over 200 people on this. This is
Yeah.
a pretty good result.
They're picking
This is
pretty
what
fast.
I feel.
Oh, you like the way they're answering?
Yeah, I like
Good.
the way they're answering because I feel like folks are missing the boat on that. And I've done hundreds of these presentations, this lease thing for years and years, and obviously the focus is on accounting. I know everybody's in lease fatigue right now. They're tired of hearing about it. At least we have a final answer. But at least the focus is in the right place, and I'm not putting the cart before the horse either. That'll make sense in a minute. We'll give you the results. It seems to be.
So if you're seeking CPE, please go ahead and get your answer in. We're getting close to 90% having responded. And we'll go ahead and show the answers. So 25% said that the most challenging thing would be compiling the inventory of lease information, 47% implementing a new process and procedures, and 16% are thinking it really won't be that challenging. Interesting.
Yeah, I think with the 60%, I agree with that. When you're only leasing office space or a warehouse or something along those lines, probably won't be that difficult because again, a lot of the things don't change. There are devils in the details we talked about, but I'm happy to see, and I don't always see this result related to the processes and controls. That's where you really will see some change, and they may not be overarching changes or major changes, but there you will see changes, and I think that's good. Folks are paying attention to that.
Okay.
And hopefully with their covenants.
Yes. So what we'll do on the next slide is talk a little bit about the financial covenants and kind of the impact that these changes may have to it. So as it relates to bank financial covenants, usually banks establish two sets of covenants. You'll have income statement covenants and then balance sheet covenants. And for the balance sheet, typically you probably have seen these standard covenants: a debt to net worth covenant, a debt to tangible net worth, funded debt to EBITDA or average funded debt to EBITDA, and a total debt to capitalization. With these changes, basically, your leverage will probably go up significantly due to the change of the accounting rules. And so it's very important that initially we're having some conversations as your banker, understanding what this number may look like for you and being able to reset the covenants. Now, the challenge I bring back again, the chicken and the egg scenario, is that we can't set a new covenant until we know actually what the adjustment's going to be. And so what I think you'll see with a lot of banks, what they'll do is a couple of things. One, they'll probably insert some language that states the covenant will be measured up until the time of implementation and then allow for an adjustment at that point. They'll also may just insert some language that says basically similar that any changes in GAAP or accounting standards would exclude the situation where you would be in default and allow to the bank and you to renegotiate. And then the other thing is they may even just recalculate or relook at how do they calculate total liabilities and exclude the lease liability from that calculation. So there's different things that the banks may do, and each bank is going to look at it differently. I think what is very important, and I can't speak to other financial institutions, but one of the things we do at BB&T is we try to provide our clients with intellectual capital and having some kind of informative information early in the process. What I would recommend is you get your CPA and your banker together to make sure you're having some good conversations and they kind of understand what the plan is for the company. Because there's a lot of factors that Sean's going to sit down with the client and make determinations on what those liabilities could look like.
Yeah, let me ask you this, James. You know, let's say you've got a debt to equity ratio, right? That's in a current, obviously, these liabilities being thrown on the balance sheet, I'd assume the ratios have to change, right?
They would.
Is that something y'all are talking about internally, or?
We're talking about internally, but here's the challenge. You really can't change that target number until I know what are you going to put in there as a number. So let's take the example here, and it's going to have some other effects too with business transactions. So if you go to the next page, we just want to give you an example where probably today you didn't think this will have an impact, and it will. So let's take a medical practice. You've got a group of 10 doctors, and this ties into what you were talking about earlier, Sean. You've got a 25,000 square foot office building, and it's owned by a related entity, 4 Doctors LLC. Well, only 4 of the 10 doctors actually own the real estate. Well, in most cases, the bank is lending on that. If the practice may not be a guarantor for us, but we'll ask for the individual doctors. In addition to that, your bank may say, to protect them, they want the practice to sign a lease for the term of the loan. In that case, Sean's going to categorize that lease as a liability now. So now the practice, which you didn't plan to have the real estate on its balance sheet, will have the debt associated with it in a sense because of the lease obligation.
Right, right.
So that changes things maybe from the original intent of how you restructure it.
Well, let me ask you this. I'll throw something at you here. So if I'm, let's just say and you see this in non-public world a lot, you've got shareholder, okay, shareholder group that own, let's go back to the previous example, Opco and Real Estate Co., right? And they have a lease agreement, all right? Well, now, and their terms, and it, we don't get short-term lease accounting and all that. And let's just say they're getting at the end of the lease term. Standards coming up. And so they need to go and get financing. They come to BB&T and say, hey, we want financing for operation with line of credit or something. If I'm the shareholder group, I'll say, you know what, I'm just not going to renew that lease, but we're going to continue it on a month-to-month basis. Why? Because I potentially get the 12-month exclusion, the asset and liability will go on my balance sheet. What do you think about that as a bank or financial institution that would?
We're going to probably look at some implied leverage in that case because they have, traditionally, they've had a long-term lease, they've had the property. We're going to probably look at that and say you have to.
We'll say there was never a lease in place then.
You're still operating out that same facility.
Okay.
You have to have that location for your business to function. So we'll look at that from an implied standpoint. Now, in most cases, from a financial standpoint, from a bank, we probably would ask you to execute it officially.
Oh, okay. Exactly.
So in that case,
that
triggers.
Right.
So that's where this really needs to have conversations with your banker and your accountant to make sure we're doing this correctly.
So talk about an accounting issue now versus when it's effective, right?
Yeah.
Because you have to really think through those scenarios. That's where this could have a major impact. Devil's in the details.
Always.
Devil's in the details.
Always.
That I could see being problematic because we see that all the time. You've got some that have leases in place, related parties, and some don't. And then where do I stand, as far as do I need to put some on balance sheet? Do I not? How does that impact my relationship with my bank and my debt covenants?
Yeah. And when you look at it, really in this scenario with the medical practice, the cash flow is for the bank to repay their loan. It's really coming from that operating entity. At the end of the day, they're paying the rent to the real estate entity. And so if we're going month to month, we want to protect that cash flow. We want to know there's an actual hard lease out there, that there's an obligation for that practice to continue to pay that rent. Otherwise, we don't have cash flow because we don't have as a guarantor the operating company.
Right. Lesson learned. Go ahead and talk to your bank now.
Have those conversations now.
Couldn't agree more. Okay, we're getting towards the end here, so we'll just a few points on adoption. As I mentioned before, this is 20 for everybody other than the public entities, which is effective in 19. And again, I'll reiterate, you got 1 year earlier for the RevRec standard, which is a beast. So warning on that. You do have an early adoption is permitted on. You could adopt it today if you wanted to, if you're that brave to do it. Now there's limited early adoption in the RevRec standard to a year, which was the previous before the amendment came out and deferred it for a year. The good thing for the non-publics, it's effective for the beginning of the earliest period presented. In non-public companies, generally you don't have to present comparative financial statements. Obviously, that's different for the publics, where you have a 3-year period in your pay filings. But the non-publics, where if you elect only 1 year, we may see 1-year financial statements a lot related to adoption of this standard. There's a modified retrospective approach, and I'll just point some things out real quickly here. there's some relief the board's trying to provide where you don't, for the leases that you have in place upon the effective date, that you don't necessarily go reassess under the new standard. Are they still leases or are they not leases? They kind of allows you, if you would like, to leave that alone, as well as the classification of those leases. So that eases the tension a little bit, but at the end of the day, they're still going on the balance sheet. Once you adopt this, again, there's some relief available to you related to the operational aspects of going them all, like using the discount rate. There's relief associated. You don't have to go back when you enter into the lease. You can look at when you adopt it, what your incremental rate is during that period. Couple real quick comments on the accounting adoption that we always like to point out, and then we'll get to our last polling question and call it a day. We always look at adopting accounting standard, new framework like IFRS. We would take folks through this, what we call accounting adoption. So being aware of some, getting educated on it, implementation, adoption, and we just gave some quick thoughts on that. And I think looks like, given the polling questions, you're on top of, or at least understand the impact on processes and controls, which we couldn't highlight more. So I won't belabor that point, but I think obviously by sitting on this webcast and other webcasts, you're getting up to speed on the educational aspects of that. But I can't stress enough on the implementation when you're developing the magnitude and the impact and all of that, and talking to your investors, your financial institution, having conversations internally, and that all the scope of that's going to be driven by the number of arrangements you have, and re-looking at your arrangements, making sure that there are leases out there that currently you aren't accounting for leases under the new standard, and getting the inventory of that information could not be more important in getting a jump on that. And then obviously on the adoption, and that your implementation, your adoption will be as successful as your implementation, because you'll be adequately prepared and having those conversations with your bankers and alerting everybody the financial impact associated with the adoption.
All right, so let's open up our final polling question of the day. Where is your organization in the adoption cycle? Are you gaining understanding, planning implementation, you've already begun your implementation, or you haven't yet done anything? So go ahead and choose your answer, and we'll find out just where people are along this process.
Yeah, that's fun.
Excellent. They seem to be voting faster and faster. This is great. I wonder why. Exactly. This is our final question for CPE credit.
See you later.
And
I would say for the result of those.
Yeah. So looks like we're at 88%. That might be as high as we're going to get. So yeah, 54% are gaining an understanding. 9% are planning implementation. I think we can go ahead and show the numbers. 7% have begun implementation, and 30% have not done anything.
Now, we'll say, this is the order. I mean, technically, they sat through this presentation, so they've done something.
That's right. That's right. You started now.
Don't sell yourself short, people.
Yeah.
You've sat through this presentation.
That's right.
So you've done something. That's good. And that goes back to accounting adoption.
Gaining understanding.
You're getting educated, and that's what people should do. But and then you'll put the wheels in motion once you've got that understanding. The last slide I won't go over. That's just some quick thoughts to accounting. Again, it sounds like this group, pretty given the numbers, pretty much well understand and what we talked about today, the compliance aspects and the controls and the accounting reporting. And this is actually a slide that I started back on day one when this thing was talked about, when it was a complete disaster. Going, this is going to be a mess, folks. You need to, start thinking. But anyway, so all right, I think that's all we have, and we appreciate everybody's attendance today.
Great.
And look forward to we'll be doing more in our accounting series related to revenue recognition. I highly encourage you to attend that, or at least get educated on that. That is a beast. And we're doing some accounting adoptions for some public companies, and I tell you, the devil's in the details of that when you start applying it. I can't, but that's coming up. So thank you, everyone.
Well, I hope our objective today was just to arm you with some items to discuss with your banker and your CPA and make you realize that this is something you need to have to think about when entering into any kind of multi-year credit facilities or lease agreements.
Thank you, James, and thanks for participating. I think you hopefully gave some clarity to folks on what their partners are thinking of.
All right. Thank you, everyone, for attending today's event. This concludes today's webcast.